Ladies and gentlemen, it's a financial show, Modern Investing on Pod TV. My name is Sasha Starr, and today we have guests, Milan Somberg. Dr. Somberg, welcome to the show.
Delighted to be here. Thank you for inviting me.
Always my pleasure. And we have Jim Eid from Eid Foundation. Welcome, Jim, to the show.
Thank you, Sasha. Glad to be
Great
here.
to have you. So, Milan, you mentioned before we opened the show that you have done a study on put-call ratio. So, please tell us more about it.
Well, there are four ways to beat the market. And if our viewers get nothing out of this meeting except find out about the four ways to beat the market, they can go home being ahead. Number one is dollar cost averaging the entire market, not individual stocks, but the entire market. Number two is correct use of puts and calls. It's important for it to be correctly used. Number three is buying. When a company buys back its own stock, the stock price goes up. The stock value does not, but the stock price goes up when a company is buying back its own stock. So those are three ways to beat the market. And the fourth way is picking the right stock. For most people, that doesn't work most of the time. And so most people trail the market, most investors trail the market, and picking the right stock sure makes Wall Street happy. They want you to buy and sell stocks frequently. That's how they make their money. And so that last one, the people with your ability can make money, but most of us cannot. So that's the important thing. Now, when I take a look at the put-call ratio, the put-call ratio is an accurate indication of how investors feel about the market itself, if you do a put-call ratio on SPY, or how they feel about individual stocks. So now, if we take a look at the put-call ratio on SPY, which represents the S&P 500, which represents the American economy as a whole, it is down for the week, but it is up a year from now. We know, for example, that the American economy will be ahead 10 years from now, 5 years from now, according to the put-call ratio, 1 year from now. It's down for the week. But if we take a look at the put-call ratio or NVIDIA, it is down for a week, and it's down a year from now. I don't know how accurate the put-call ratio is, but nothing works all the time in the market. Very few things do. Dollar cost averaging is an example that does. But when you take a look at the put-call ratio on NVIDIA a year from now, it's negative. You sold some puts, you're a winner.
Well, I guess I was for the last few days, I was waiting for a day like today. Although it's Wednesday, usually stocks are up. Today they're down for a change.
Short week.
And well, with NVIDIA, if you take a longer view rather than a few days from now, this stock already touched 500 interim. What makes you to believe that it will never be 500 again and stay and go even higher than that?
What makes me believe? Well, the put-call ratio shows what the majority of investors, how majority of investors feel.
But the majority of investors are trading the market by 40%.
Yes,
How indicative is that majority to somehow to induce me to do any transactions? Because all I will do, I will follow the losers who are losing 40% of their money or so, and I will think, what they're thinking about putting call. Do I care even a touch about these things? Absolutely not. Not even interested.
I know when it comes to market forecasting, you listen to your wife.
To my wife, and she delegates it to me entirely. So essentially, I'm listening only to one person in the world. It's myself, no one else. And you forgot to mention the fifth way to make money in the market. You know, this is a common sense. There is a common sense, and that is a widely could be misinterpreted. Although the common sense, for example, you're waiting sometimes a month, 3 months for a day like today when Nvidia is on sale. I expect it to go much lower than that. It will go, in my opinion, to 430, 35, something like that. But I already took position because it's not going to go straight way all the way down every day, every hour. It's not going to happen. It went down today. It will probably will go lower tomorrow, but then it will going somewhat higher. It will go mostly 480, 485. Then it will resume its downward. So you can trade, and I sold this put. So if the Nvidia will go up to 480, there will be already substantial profit on this trade. I'll tell you why. I got for each put I sold, unbelievable $60.50. So now for me, start to worry about anything. Nvidia has to indeed go down to 435. If it will be by January, which is quite unthinkable when you know that December and January are pretty good months, I don't think it will be 435. It will be somewhat higher. And I think that it will be well over 500. It will be 510, 525. I'm not sure, but it will be higher than 500. So in a way, if you pocketed $6,500 on each put, how can I argue with that? So somebody paid me, believe it or not, somebody paid me $6,500 for each put.
What?
I could never believe that it's possible, but it is because I have them already on my account.
And that's somebody who paid you that much money for a put lacks common sense. You told us that the fifth way to make money on the market is to have common sense. If you have a large number of people in a room, say 100 people, and you ask them to put their hand up if they're a below average driver, very few hands will go up, and half the people in the room are below average drivers. If you ask them, how many here lack common sense? Put your hand up.
Okay, Milan, I will not generalize really here, except one thing. You have to understand who is on the other end, because you believe that you're smarter than the person who was sitting on the other hand. But I can tell you, if it's not really option, it doesn't matter call or puts, which have a significant volume, which is closer to expiration, which is closer to strike price. On the other hand, you're definitely dealing with the market maker. Also, by the difference between bid and ask, the volume of trading, you are dealing with the market maker. And I don't think that he enjoys his position by paying me $6,500 per one put. But he has to do it. He's making his money elsewhere by trading thousands of options with close expiration back and forth. But here, because he's a market maker, he must provide the market. Thank you. I have no problem with that. Thank you for providing the market. And the market is always there. It will be there for the rest of today and tomorrow and next week and next month too. So I would like to thank the market maker on NVIDIA by allowing me to pocket well over $20,000. Thank you very much.
And we don't have to feel sorry for the market makers.
No, he's making his money elsewhere. If not, he would be fired in no time. Because a company like Goldman Sachs, why would they have a market maker that is losing money?
Losing money, no, that's not consistent with the corporate culture.
Absolutely. So having fun, to tell the truth. I love this, and it's really common sense trading, considering the stock, the expiration date, the time left, and knowing who is on the other side of the trade. So when you think about all that, that is what I would call a common sense trading. I don't know if you can learn it in any university or any school. I'm not sure. That's something what you have to dig into it and find it for yourself. I don't think there's a way to learn it.
And I found that it's possible to educate yourself. You can look at all the resources that are available to you, and you can find out. And also, put your money up, because it's all theoretical until you actually have some invested into the market.
Absolutely.
And,
Absolutely.
and then you learn. You take your lumps and you gain your experience, and then you become more sophisticated and know what you're comfortable with and what you're not comfortable with. But I'm like you, Sasha. I'm always interested in what the public thinks, because I'm a contrarian, and I'm always kind of tempted to bet against what everybody else is saying. It's like everyone's saying that the American economy is doing so poorly, and then they report that they're doing pretty well. So, how do you have this disconnect?
Yeah.
Because the American economy is doing pretty well. But we have this gloom and doom thought out there. So I wouldn't bet against the American economy right now. So I kind of agree that the S&P 500 will be higher over the course of the next couple of years. And it is a smart thing to invest in that. But when you look at a stock like NVIDIA and you say, okay, as I told you before, Sasha, I sold, and the reason is because I don't like volatility when it's going up or down and that kind of stuff. So it's uncomfortable to me, and so I know myself. I know what I'm comfortable with and not. And I don't want to wake up and, oh gosh, it lost 30 points today, or happy days, it gained 15. I pretty much wanted to see the trajectory go straight up, which it was doing for a long time. And now I'm not so confident that it's going to be straight up. So I got out. But I'm keeping in mind that it's still a good company, and I want to see where this settles into what is its proper trading range. I'm not so sure I know.
Jim, this is exactly the reason that I still hold two stocks. But essentially, once all these options will either expire or will be exercised, or whenever it's done, I will have no stocks in my portfolio, period. I don't need them. I need pocket money on options, because the object of the game is to make money. And to make money, you need to see green on your screen. I've just checked. I already can pocket $450 on these two puts, because NVIDIA is moving slightly higher. I'm not going to do that, because if I can pocket $13,000, what's $400, $500? Why would I do it? I'll just keep this position. Actually, now I regret that I didn't sell 10 puts. It would tie up my margin, though, but still, at least 6 I should have done. But there will be a time when I will do it. I won't right now. If I will start making about $3,000-$4,000 profit on this trade, I will liquidate the trade and wait for another downturn on NVIDIA. We'll see. We'll play it by ear. And what I'd like to mention is that the dollar cost average, I don't believe that it works, especially on the way down on stocks. To me, it just doesn't work.
On stocks.
On stocks, yeah. No, S&P is a different thing.
Yeah, right.
Maybe there are some merits. But on stocks, I believe in dollar cost averaging on the way up, not on the way down.
That's called momentum investing. I mean, if you're investing in
it's not momentum. No, I disagree. If you got, for example, Jim, remember when you have NVIDIA, you paid 180, and it was going, it went down, but then it was going higher and higher. So if you would buy more stock at 220, more stock at 260, and more stock at 320 or so on, you would make really very, very good money, and you would be all the time, you would be in the green. from that point when you started to add your positions, green and green and green and green. When your cost averaging down, it's red and red and red and red. This is compare this to animals. It looks different, it sounds different. In one case you're making money, in another one you're losing.
You're right,
But
Sasha. You could dollar cost average Enron and not do very well at all, but that doesn't apply to the American market as a whole. American market, they say American market is not doing well. They were talking about that in the former Yugoslavia 30, 40 years ago and in Serbia today, because that's what they hope happens. But that the Russian submarine went down some years ago. I think it was called the Kursk, and it went down some years ago, and of course everybody perished. And the widows were compensated in rubles, and Putin himself suggested that those widows take those rubles and change them to American dollars. What does that tell you?
tells you a lot.
Yeah, it does, doesn't it? Yeah.
Yes. Well, Sasha, when I bought it, NVIDIA, it did go lower. But my feeling about this type of dollar cost averaging or whatever, it didn't matter to me because I knew it was a good company. I knew it was going to make go higher. So even if it went down to 160, I was not upset because I didn't look at it as red. I just looked at it as pre-green. It wasn't green yet, but it was going to be green. So I had confidence. The other thing I wanted to say is another option. The way that I did this when I started out. First earning a paycheck, I took money before I saw it. So I put money into the company that I was working for. They deducted it from my paycheck before I saw it, because at that age, if I saw it, I spent it. So what I did was save by investing in the company, and they matched it for
Yeah, it's a good way to build
yeah,
up.
or they didn't match it. They matched 6%. But what it did was invest the same amount of money over time, every period of every paycheck, the same amount of money over time, whether the stock went up or down, it didn't matter. It was always the same. So when I invested, when the stock was down, I got more stock.
Yeah,
and when the stock was higher, I got less stock, but I kept doing it over the course of many years.
Yeah.
Say, 5 to 8 years or whatever the period of time was. I had a nice chunk of change, which I used to invest in my first home.
You picked the right stock there, James, because there are people who were encouraged to do the same thing with Enron.
Yes, absolutely right, Milan.
And some of these people now in their late 70s and 80s are greeters at Walmart.
I agree. It's so tragic. I agree completely. I got lucky with the company did well. Yes.
Yeah.
A good point.
Yeah.
And the good thing about Enron is some people went to jail. Maybe more should have. But in Canada, we had a similar situation. Nortel, was a telephone manufacturing company, was making equipment, and it went from about 120 to 60. And the Toronto Dominion Bank executives encouraged one of my friends to buy it at 60 because it was down to 50%, and it continued to drop right down to below $1, and nobody went to jail, and the people at the top walked out rich. Now that was
$60 for some reason. $60 on Nortel is a very significant number, because I remember a friend of mine, he's a chess player, and when it reached 60 on the way down, he said, "Okay, I'm going to put a mortgage in my house and will buy shares at 60." And I said to him, "Why don't you put an order at 55? You might as well get filled." And he changed his mind about taking mortgage on his house. Sasha, I love what you just said, because if I could buy it at 55, maybe it will go to 45. Then I will buy more. I said, "Well, you know what I'm going to tell you is wait until it will be 25, and you'll buy many, many more shares than you would buy at 45. Anyway, we know all the story. Listen, you have to understand the risk what you're taking. There is a risk on single stock. There is a risk on NVIDIA. What they can say is that There is a bunch of companies that have now much more sophisticated chips than we do, and they produce it much better than we do. And actually, we already have few companies that canceled their orders for our chips. So we are closing a few offices, and we are firing 5,000 people. And next quarter will be bleak, and the following quarter will be even worse. Stock will go from 470, where it's now, to $55, and you pay very
Can I
consequence.
say a few words about risk, please, Sasha? It's important to understand the definition of risk is a risky security is one that has a lot of volatility. And a safe security is one that has very little volatility. An example would be cash. But cash is a guaranteed purchasing power loser over time because of inflation. So yeah, there is no volatility with cash. It guarantees loss, guaranteed loss if you hold it long enough. So that volatility as a definition of risk really doesn't stand up nearly as well as Warren Buffett's definition. And Warren Buffett's definition is risk is not knowing what you're doing. There you go. Risk is
No,
not.
no, no, it's different animals. If you don't know what you're doing, it means you're ignorant about
You're in the wrong
it, and you're just
sphere. Yeah.
there for no reason whatsoever. Now, if you are calculating your risk and you see different scenarios, okay, here is a worst case scenario that NVIDIA, I don't see that scenario that I just described. I don't see that happen because actually they're predicting even better results next quarter and so on.
Yeah.
And so far their track record is absolutely amazing. They're beating
There's no
Not-
question about
times
that.
they're beating expectations. So now they're doubling down. They're raising their own expectations in order to beat them. That's what can make that stock well over $500 because they're raising, not the analyst, not the you're quoting Morningstar, right?
Yeah.
No. It's a management of the company themselves. They are raising.
Yeah.
the
That makes me nervous.
Well, they don't need to do it because if they keep the expectations relatively low, it's so easy to beat it. So
Yeah.
your stock will go for. But they're raising it because they can be accused that they perhaps knew that there was a spectacular quarter and they didn't make any announcements.
Right.
And all of a
Right.
sudden, they exceeded expectations 235%. So why wouldn't you make any interim announcement to so there is one company recently, I think it was Autodesk, another one that I'm following. The Autodesk, they made earlier quarterly release because they had spectacular numbers and they were scared to hold it to all time because then the blockbuster quarter. So they made a special exception to make their results earlier than they should have. So you have to watch the companies.
The companies do try to manage expectations.
Yes.
And that's something that you do have to factor in. And what they're telling you is always, like I always think of as, I never try to beat the smart money, either buying something when it's at its lowest or selling something when it's at its highest. I always think that the smart money is going to know more than I do and be smarter about the peaks and the valleys. But what I want to do is get in it towards the low end when I buy and sell towards the high end. And so these types of announcements that we're going to have these magical earnings, this is going to not magical, it probably will perform to that level. And so money will swoop in and drive the price higher. And so I'm not touching it at that level.
I'd like to mention about a lot of people when talking about stocks, they are recommending diversification, and S&P 500 it's ultimate diversification. I have a different view though. I have a view that it pays off much better if you're becoming specialists in a handful of stocks. You have two, three, five maximum stocks that you know a lot about the company, its reports, so you know their trading parameters. You even know
Yes,
during the day when they're trading heavier, when there's less volume, and so on. You need
I agree with this.
maximum five
You
stocks. You
you
don't
know,
need.
you know that Gerald Loeb, who wrote that book, The Battle for Investment Survival, he wrote it more than 80 years ago, and the book is still in print, and it has a lot of really valuable suggestions, recommendations in it. And so he said, put all your eggs in one basket, and then watch that basket. And somebody called diversification, they call it diversification. Yeah, because if you put all your eggs in one basket, but let's say buying SPY, that basket is the American economy as a whole, someday it will fail, but not in the
But you see,
future.
Milan, there is a payoff by buying S&P 500. You're buying 500 companies, including Nvidia and
Sure,
Netflix
of
and
course, yeah, right.
Meta and all the best stocks. But you're buying also worse stocks as well. You're buying Walgreen, Boots, which went from
Sasha, that is a way of looking at it. However, suppose you look at it as you're buying the American economy as a whole, including the weak ones, but the American economy as a whole has outperformed all other economies for over 100 years and is likely to continue doing that. So yeah, it includes the poor companies, which is
Milan.
yeah.
I think your theory suits very well novices, people who don't know nothing about
Oh, not
stocks.
only that.
And you're right. But you can teach your 10 years old to do that. I
No,
agree
no,
with that.
it suits beginners. That's true. You know,
Good.
we can teach a high school student how to equal the market in less than 10 minutes.
But
And
let me ask you, Dylan. So you taught a 10 years old to do this S&P stuff, and he's doing that for 2 years, 10 years, 20 years, 40 years, and he's doing still the same thing. You know what I would say about people like this?
Mhm.
Guess what? Okay, several available names.
Yes.
I'm not going to mention those names,
But
but they would
Sasha, I've got
know.
a point to make here. Is one of the first books I read, because we were talking about diversification, was Andrew Tobias's "The Only Investment Guide You'll Ever Need," and I just
right,
looked it up, and it says over 1 million copies sold. And so Andrew Tobias is the guy that made the most money out of that book. Not anybody reading it, but he did talk, and this is testing my memory, but I believe he thought of diversification was an important thing, and he recommended it. But I think he was talking about the asset allocation rather than number of stocks. You know, it's like diversify and have some money in stocks, have some money in cash, kind of thing. That's what he meant by diversification.
Oh no, that's
And
true. Yeah, that's true. You know, Jim, that asset allocation is the most important part in portfolio performance. For example, if you have a 50-50 asset allocation, say 50% is in cash, 50% is in the American economy as a whole, including the strong and the weak markets. When the market goes up, only half of your portfolio is going up. Conversely, though, when the market goes down, only half of your portfolio is losing in a 50-50 asset allocation. On the balance, you're ahead owning a 50-50 asset allocation. On that alone,
I have a feel that this concept of S&P 500 and the American economy as a whole, it suits very well people providing certain crutch that if market is going down, well, S&P going down, everybody is going down. So I'm going down just as well as everybody is going down. And this is very elegant crutch because your friends or your wife or your relatives, nobody will accuse you of anything. I bought S&P 500. So
Yeah.
everybody went down, I went down, then it will go up, I
Yeah.
will go higher. So, but in the meantime, for years, you will be sitting with the red in your portfolio. So I'll tell you, after a month or two, you will stop even looking at your screen because there is nothing but grief, and watching this is quite
Sasha,
painful.
Sasha, listen to this. Here's a way to make 15.6%
I've heard
guaranteed.
that.
You heard
Yes.
that.
No, it's not guaranteed. No.
And if half
Not
of your money invested in 15.6%, then you're making over 7.8% annually, inflation adjusted. Now, who needs more? Where what I'm describing here, is guaranteed. What you do
It's
is
not.
on a Monday, you sell covered call, you're in cash, let's say. So you sell cash secured puts on SPY. And you keep doing that every Monday, and you get a very nice return of about 15.6%. And if the stock, if SPY is put to you, now you own it. That allows you to sell covered calls on it. And you sell on a Monday, expiry date Friday of the same week, covered call just out of the money. And you keep on doing that until you're assigned and it's called away from you. Now you're in cash again, which allows you to sell cash secure puts on it, just in the money. If you keep doing that, you're right. It can be taught to a high school student. You say ignorant people. What about people who don't have time to do what you are doing? Most of our
They
members,
don't need market at all. They don't need market. They can collect violins, some rare wines. They don't need the market. They will lose 40%, period. So you want to keep 60% of your
Well,
money or 100% of your money?
let me give you an example of what I think of as the difference in your perspectives, because I've said often that you're both right, depending on the perspective. I used to enjoy getting first edition books and of certain authors, one in particular, and I would go wherever I would go into another city. I would go looking for first editions of this book. This was before the internet, and it was a great adventure for me. I really loved doing it, and when I would find one, I would buy it, and it really didn't matter what they were charging for it because it was a new one to my edition, and I had almost all of the person's prolific output and first editions, and I was only looking for a handful more. And then the internet became very popular, and I could find them online with just a few clicks. All the fun went out. It wasn't an adventure anymore. And so part of my attraction to what Sasha's saying is because this is, I believe in concentrating in a particular sector, individual stocks in that sector, knowing my knowledge is better than the average person's knowledge out there. And the average investor is not going to be able to outperform me. And so this is the fun that I have in investment. But if I was going to train somebody who didn't have the time to be a sophisticated investor and to really develop the skill and the knowledge, then I would tell them, do what Milan is suggesting. So you're both right, depending on who you're talking to.
Question for you, James, is we're talking about investing and investing in the stock market. We talk a lot about that. But I know several people, and so do you, who don't invest in the stock market. They invest in real estate, and they buy.
Yes.
And then ultimately they sell. And by picking correctly the right areas, say Toronto is growing, and Vancouver is growing, and San Francisco used to grow. But for every San Francisco, there's a Detroit. For every Toronto, there's a Sarnia. Can you make money in books, collecting books? Can you buy books today, which 20 years from now will be worth more than you paid for them?
Oh, absolutely. And just not me.
Just for dummies. I would say just for dummies is one.
We have a book fair in Toronto every second year, and I attended a couple of them, and I noticed that the book by Captain James Cook is selling for $175,000.
Wow.
Yeah, and that's the priciest book of them all. So somebody paid much less than that for it.
Yes.
But with the right knowledge, you can make money in books.
No question. No question. And that goes for lots of different commodities or different things that we can talk about in terms of investing. And a lot of it is knowledge and getting in it when it's not as expensive, and then waiting until it's more expensive to sell.
You know, somebody said that if you're going to invest in art, don't buy any painting under $200,000.
Yeah.
Yeah, if you're going to invest in art, make sure that it's something that's collectible, and $200,000 is kind of the minimum. Is there such a minimum for books, James?
That I couldn't tell you, but I also is art is another subject that I shy away. I don't. My wife is the art investor in the family, because I don't know what would be worth more later, and what would be worth the same, or I have no knowledge in that area, so I stay away from it. Now with books, it was only very selected books, very small, and the internet really hurt my calculations, set my calculations off, because they became cheaper. After when I had gone out and gotten all these things and acquired them, I had put time and effort into doing so. But with being able to go to eBay and buy one, everything was cheaper. So my calculations were all off.
I'm going to provide just for illustration purposes. When I was following, Milan, what you're suggesting about selling cash-covered puts on S&P, and then you exercise, and then you do this and that. Let me just, for illustration purposes, tell you that S&P now is 445 or so. So if I will take 19th of January of 2024, 460 puts, which is a touch higher, same as what I did today earlier with NVIDIA, you will collect for each put $19.60. Say you will wait until it will be 20, so you will collect 20. And for the same margin of NVIDIA, same percentage between today's price and 500, you collect, or at least I collect, $60.50. Do you feel the difference? Feel the difference. So doing the same thing, pressing a couple of buttons, you're getting 3 times as much money by doing the same work and taking approximately the same risk. Okay? Actually, I think that on NVIDIA, it will be actually rewarded faster and better than on S&P. That's my opinion.
Yeah, I'm just curious because you asked Milan, so I'm Mr. Look It Up and everything. And there are some very interesting and rare books that have some interesting value and everything. There was actually an article in Reader's Digest, and some of them you might find interesting, but apparently William Shakespeare's First Folio, which was one of his early works and everything, is worth $5.2 million and everything. But then on the flip side of that, In Our Times by Ernest Hemingway, and it's in one of his early releases, is worth $321,600. And surprisingly, and Jim may find this interesting, Harry Potter's and the Philosopher's Stones, which is J.K. Rowling's, one of their early works, was worth $55,000. So in the top 3, we went from several million to $55,000. And all along those lines, I also see that Pride and Prejudice by Jane Austen has got a worth of $180,159.
Oh, that's low.
What's your source, Mark? Give me again your source again, please.
Reader's Digest. There was an article on Reader's Digest on some of the things that were in books that were worth money and everything. And this was an article that was published actually earlier, was updated earlier this year. It was updated on July of this particular year, 2023 and everything. So it was a Reader's Digest article. Casino Royale, and some of our friends may be James Bond fans and everything. $130,000.
There's only one publication that has a bigger circulation than the Reader's Digest. The Reader's Digest is the second most commonly read book magazine, and the one that's ahead of it is the Racing Form.
Oh, that makes sense. Here's an interesting one for you, both Jim and Milan, but Canterbury Tales, and I do remember that from my college days and everything. In 1988, a first edition of that book sold for an auction at Christie's. A billionaire philanthropist named Sir Paul Getty, many folks know who Paul Getty is, bought it for $11.2 million. So he bought that particular book.
Yeah, you're not buying that to read it. You're buying it as an investment.
Paul Getty, by the way, had a wonderful way of getting rich. He told people how to get rich. He said, to get rich, rise early, work hard, strike oil.
Hey. Sounds good.
Okay. Guys, I would like to thank you very much for today's program. And we'll see you next week, same place, same time, and hopefully in green. Okay?
In green.
That's what's the most important thing.
Green
Sounds
on your
good.
screen.
Thank you. Bye.
Thank
everybody.
you, Sasha. Bye-bye.